Assalamu alaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Salma Alisha Sahdiya NPM 234120046 Accounting Class 23A. Course of Market and Financial Institutions. Here I will explain about banking and non-bank financial institutions. Let's listen to my explanation. Definition of financial institutions. Financial institutions are entities that provide financial services, such as money management, savings, lending, and investment. They play a vital role in the economy by facilitating the flow of funds between borrowers and savers. They fall into two main categories: banking financial institutions and non-banking financial institutions. Definition of bank financial institution. A bank is a financial institution that functions as an intermediary in collecting funds from the public, customers, and distributing them in the form of loans. Types of financial institutions. Banks. 1. General bank, providing banking services to the general public with products such as savings, deposits and loans. 2. People's Credit Bank, BPR, financial institutions that provide credit and savings to small and medium businesses. 3. Central bank, functions to regulate and supervise the financial system, control inflation, and maintain currency stability, for example, Bank Indonesia. Functions of bank financial institutions. 1. Collecting funds from the public through savings. 2. Distributing funds in the form of loans to debtors. 3. Providing payment and money transfer services. 4. Issuing payment instruments, such as checks and credit cards. 5. Providing investment services, such as time deposits and mutual funds. Definition of non-bank financial institutions. Non-bank financial institutions are entities that provide financial services, but are not licensed as banks. They do not accept deposits from the public, but offer other financial products and services. Types of non-bank financial institutions. 1. Finance companies offer financing for the purchase of capital goods, vehicles, and property, example, leasing. 2. Insurance, provide risk protection to customers by paying premiums for future claims, example, life, health, vehicle insurance. 3. Pension funds, manage pension funds to provide post-retirement income for their members. 4. Investment institutions, offer investment products such as mutual funds, bonds, and stocks. 5. Savings and loan cooperatives, collect member savings and provide loans to cooperative members. Functions of non-bank financial institutions, providing alternative sources of funding for individuals and businesses, managing risk through insurance products, facilitating investment through various financial instruments, providing more specific and flexible financial services. History and development of banking and non-banking financial institutions in Indonesia. Financial institutions in Indonesia, both banks and non-banks, have a long history that is in line with economic development and the community's need for financial services. Since the Dutch colonial era, financial institutions were first introduced through the establishment of De Javash Bank in 1828, which functioned as a circulation bank or central bank. After Indonesia's independence in 1945, banking was nationalized, where De Javash Bank was changed to Bank Indonesia in 1953, which now functions as a central bank and monetary policy regulator. During the New Order, around the 1970s, the banking industry underwent liberalization, which encouraged the establishment of various commercial banks and the development of the private banking sector. On the other hand, non-bank financial institutions have also grown rapidly to meet the needs of the wider community, such as insurance, financing institutions, and securities companies. These non-bank institutions emerged to serve needs that were not covered by banking, such as consumer financing, investment, and risk management. With the issuance of the Banking Law in 1992 and the Financing Institutions Law in 2014, the government began to strengthen regulation and supervision of these two sectors. Today, with the advancement of technology, both banking and non-bank financial institutions are increasingly integrated with digital services, creating a financial ecosystem that is more inclusive, and easily accessible to all levels of society in Indonesia. Introduction to Financial System in Indonesia. The financial system in Indonesia is a network of institutions, markets, and instruments that support the flow of funds between parties with surplus funds, fund providers, and parties in need of funds, borrowers. The main institutions involved in the Indonesian financial system include Bank Indonesia, as the central bank, the Financial Services Authority, OJK, as the financial sector supervisor, and the Deposit Insurance Corporation, LPS, which guarantees public deposits in banks. This financial system consists of various components, including the banking sector, capital markets, and non-bank financial institutions that provide other financial services, such as insurance and pension funds. The main objectives of the financial system in Indonesia are to maintain monetary stability, support economic growth, and ensure public welfare by facilitating efficient and inclusive funding. As an effort to adapt to global and technological developments, the financial sector in Indonesia has also begun to experience digitalization, with the emergence of technology-based financial services, fintech, which are increasingly used by the public. That's all I can say about banking and non-bank financial institutions. Waalaikumsalam warahmatullahi wabarakatuh.